Welcome to Build to Scale e-commerce show by Atkins Agency, and today we'll be interviewing Daniel Rodic, a Forbes top 30 under 30 list member and the head of market development at Clearbanc, the biggest e-commerce investor in the world. And in this episode, we'll be diving deep in how e-commerce businesses should be funding their growth, covering their marketing expenses, and scaling the business to the next level. So Daniel, super happy to have you here. I mean, it's crazy that over the years, I'm able to connect with people like you, that are running, I guess, the game at a completely different level.
Mm-hmm. It's so super excited to be part of the show today. I really love what you guys are doing. I'm so happy we met through that Deliver, I guess, conference or event, virtual event, we can call it, a little while back. So I'm excited to dive deeper in what you're working on and hopefully add some value to your audience today.
Awesome. Perfect. I mean, it's far short, calling somebody a conference right now. It's at most a webinar, but I mean, like Corona does its things. So anyways, could you maybe briefly introduce yourself more to the audience? Maybe tell your story, because I know you have like very particular story where you like grew a few businesses, sold them, then transitioned into this kind of things.
Yeah, no, happy to give you a bit of background. So I'd say my entrepreneurial career, the first thing I ever sold online actually was my Gameboy. I had an old Game Boy in the height of like eBay, and I was bored with it. I'm like, I'm just going to try to sell this thing and see if I can make some money off of it. And I also had some memory cards and stuff. And this is all over one summer, where I learned that like memory cards, for whatever reason, you could buy at a very cheap price and sell for like a pretty good margin. And so I took the $100 I got from selling my Game Boy and stuff to buy a box of junk that I knew in the list of things had a bunch of memory cards, and then, sold those at like $20 a pop. And so that was like my thing I did one summer. And after that, I actually wasn't like super entrepreneurial or anything like that I went to school for finance, and, I thought that's where my career would take me. But through a number of different things I did in school, I met a friend of mine, and we built a company called Luxbox, which was one of the largest beauty subscription box companies in Canada. Right at the height of when you could do a subscription box for anything. So right when Birchbox launched in New York, we were launching here in Canada. And this was before the age of Facebook ads and Instagram ads. And, at most you had some kind of display, but it wasn't really the evolved ecosystem it was today. And so we built our business primarily through influencer marketing. But again, that was not the era where we had to pay. It's if you sent someone a box, we had people with 10, 20, 30,000 subscribers, which at the time was pretty large, to write about us. And then we did a lot of deals with publishers where we bundled our subscription with beauty magazines, which like no one gets today, but 10 years ago was still a thing. And so that's really how we built the business, but learned that the market for this wasn't really as big as we thought. And we only had a couple of paths of raise a bunch of money, enter into the US, launch a retail store. At the time, we're only doing sampling, whereas Birchbox was doing retail and sampling. But because and this will eventually go into our conversation about fundraising, because we didn't really time our fundraise where there's like a good momentum story, but we kind of hit this cap, and we're like, okay, now we need money. If there's no growth story, an equity investor, especially a venture equity investor, is not really excited to put in money into the business. And so we were forced to figure out, okay, what are our other options here? And so, we went a few different directions. We basically split our team into three, where one group of us, so I took over just like overseeing this business. And then we had two teams go. One was working on a subscription pantyhose business, which arguably I'd say is not a terrible idea, but we were too young back then. And we focused our business on Canada. And, it was really good in the wintertime, but come summertime, the business just fell off a cliff because women don't wear tights in the summer when it's warm. And we took that as a bad sign when really it could have been a pretty decent eCom business. It wouldn't have been a venture scale business, but again, our mindset was very focused on let's do big, amazing, billion-dollar ideas only. And in parallel to that, we tried to test out starting a food box, which had we thought of it as a meal kit, and we never did. It was just food sampling. We had a deal on the table with the Food Network at the time to do something together with them. But we thought of it as like, who's going to pay $50 to sample barbecue sauce? This is a dumb idea. But had we thought of like basically delivering groceries to your home, like a Blue Apron or HelloFresh, we would have been like one of the first to market with this idea had we thought of it, but we didn't. So, we get no credit for that. And we were just basically trying ideas. And then at one point, there was an online retailer named Beyond the Rack, which was one of the largest flash sale retailers in the world, similar to Gilt Group or Rue La La. They were the biggest ones out of Montreal here in Canada. And they were also going to do some kind of work with us. And we couldn't figure out a way to partner together. And at one point in some conversation, they were like, well, we want to work with all the luxury beauty brands that you work with at Luxbox, but we just, we're not good at getting in touch with them wanting to work with us. Yeah. Could you help? And we're like, well, yeah, we know them. And so we gave them a call, and we basically came up with this idea of, instead of using our box that we have to pay in money to acquire customers to ship them a sample, why don't we just piggyback on another person's box? And we went to P&G at the time, and we're like, hey, here's this new idea. We have this big retail network. At the time it was Beyond the Rack. We had this big retail network where you can target the same audience as we were doing with Luxbox, but instead of being in the tens of thousands, now it's in the hundreds of thousands or millions of customers, and it'll cost you $1 per sample. And they're like, okay, interesting. And then within a few weeks, they gave us our first contract, and we're like, okay, that was relatively easy. Yeah. Given our first contract was something like $80,000, and we're like, let's try it again. And then we did something with Crest, and it was a $300,000 contract. Okay. And then we pitched.
We have something here, right?
Yeah. And so, basically in the first 90 days, we did about $1 million in bookings. And we're like, crazy. Oh, okay, so this is actually the business idea. Let's put all our energy behind it. And so essentially we pivoted our team, where I then started working on this idea. And we had our head of marketing graduate to run the Luxbox business with the idea that we would eventually sell the business, and we sold it to a competitor in the space. And then we basically ran Exact for the next 6 years, where the start of the business was very focused on just CPGs, so consumer packaged good companies like Procter & Gamble, Unilever, Johnson & Johnson, and then distribution through e-commerce. So our main partners by the end of the business were companies like Kohl's, JCPenney, Walmart, Gilt, Rue La La, basically the largest online retailers in North America. But towards the latter half of the business, we saw a huge growth in direct to consumer, where we then started doing a lot of work with folks like HelloFresh, which would distribute a gift card through pretty much every parcel in our network. And so we did work with all the meal kits, all the mattress companies, all the kind of the forefathers of D2C. When Casper first did their big Subway takeover, that's when we were going into the D2C market. And so anyways, we built that business, and we had the largest distribution of packages in North America. And eventually we were trying to think same kind of existential question of where is this business going to go next? It was an order of magnitude better than the last business, but it still wasn't going to be a $1 billion
billion dollar business what you're aiming for, right?
Exactly. And we saw the path really was that most of the companies that were doing what we were doing in other markets that were bigger than us were just a traditional agency. So doing not even digital ads necessarily, but more, outdoor, out of home, your very old school agencies that happen to also do package inserts or direct mail just through the USPS or whatnot. So we we really don't want to do that. And that didn't excite us to become an agency, because at this point we went from being a very manual business of where it was an agency, where to do these deals, I just brokered each side, to we actually built a self-serve platform with the idea of making this more programmatic and technology forward. And we basically went through the process of one company was interested in acquiring us, and then we had a whole bunch of other offers of people who were interested, and eventually did a deal with a company called The Specialist Works, which was an agency out of the UK that entered into the US that we were doing a ton of work with already. And it just made sense for them to take over and really gain a foothold in the US market. And so they were the largest players in the world doing this outside of North America. They had clients in China, clients across Europe, and then just starting into the US with our work together. And so that deal was done end of last year. And in parallel to all this, I've been friends with the folks who started Clearbanc, Michelle and Andrew, for a number of years. And my whole background was as an operator of an e-commerce business, and then doing a lot of work with partners with everyone in eCom. And so that's why I decided to take that skill set and join Clearbanc, because I think this company is doing something incredibly special, where the business when I joined was, probably 150, 180 employees. We're now at over 250. This summer, the last number, the company's almost doubled.
Yeah.
We deployed over $1 billion in capital. Like, it's really on track to go public and be the next big player in the world of e-commerce. And it's really revolutionized how founders can fundraise, or really don't have to fundraise. And that really
we'll be talking
me.
about that. Yeah.
Yeah. And so that's kind of what brought me here today. And so, again, at Clearbanc, I'm just very privileged to be supporting a number of our founders through bringing on different partnerships with, all aspects of the eCom infrastructure. So whether it's payment processors or shipping providers or technology providers, I'm in the market trying to figure out what do our founders need and how do I bring these solutions to them through our partnership programs.
And this is what's interesting, and this is why I wanted to talk with you here. And, this is kind of like, I guess, a situation that a lot of our clients face when we're growing fast and scaling, etc. We just run out of cash, right? And usually the problem starts that we are not able to order the stock. And we have like these kind of dead months, right? Where, out of the 12 months, we're actually like selling only maybe for 7 or 8, right? Because there's like lead times, etc. And depending on the products and where we're manufacturing, it could take up to 6 months to get an order. And you have to meet, minimal order quantities, etc. And this is why I'm so excited to talk today, because, your product would be an exact solution for that huge pain point that, so many businesses are facing out here, and could bring such a huge value. So maybe you could expand a bit, when e-commerce startup or a business should be considering a funding, right?
Yeah, so I think there's like different types of funding for different use cases, right? So, as you can think of it broadly as there's really 3 types of funding. There's equity funding, debt funding, and what Clearbanc has really been pioneering is what we're calling revenue-based financing. So it's essentially the difference is when you take an equity deal, I'm selling a piece of ownership of my company, and that's gone forever until I buy it back, probably at a huge premium, or I go public, or I exit, or whatever.
Yeah.
Debt is, a credit card is an example of debt. There's different types of loans, but really the features of debt is there's typically a compounding interest rate and some type of fixed or forced repayment period. Which will work for, there's a lot of good solutions. If you're an e-commerce business that's doing your own manufacturing and you're at that scale where you can get, lease financing for your machinery, or if you're producing food and whatnot, I think that's very useful in those cases. And, the trade-off there is depending on the size of business, you're often giving up some type of security. So in the early days, if you just get a regular bank loan, most often you're putting up your own personal livelihood, where if you give up what they call a personal guarantee, that means if you can't, as the company owner, pay the loan, they're going to come after you, the human being, for your house or your assets to do it. I'm not saying every loan has that, but when you're an early stage business, and especially if you're in a market where the banking infrastructure is not really great at lending to unprofitable early stage companies, you're going to face all that. At the higher end, if you're one of those, Caspers of the world, the darlings of D2C, where you've raised a bunch of venture money, you get access to something called venture debt, which is typically, good cost of capital. But again, you're trading off security and assets where they will have rights to all your assets in the case of the company going default or not making payments or whatnot, which again, it's not a good or bad thing, but it's more of just a trade-off of maybe you're getting better prices, but you're actually putting up a lot of security if things don't go as they planned. And every founder knows, 50-50 shot, you do something wrong and things won't go as planned, right? We all dream of better, right? And so where Clearbanc comes in is we're a different product in that we're tied purely to your revenue and your growth, and we're built to fund that growth. And so unlike equity, which has a crazy cost of capital, it's irrecoverable. Unlike debt, which has all the security, it takes you a long time to sign up for and get access to. We have tried to make it really fast and easy to get access to capital, where simply you connect your accounts. We judge you purely on your business performance. So we really don't know who you are as a founder, and we ultimately only care about how's your business perform and how do we think it'll perform in the future. And we use this data-driven investment model to say, here's the capital we'll give you today. You pay us back as a percentage of your revenues. And that means if the business, hits a rough patch, hits a slowdown, our repayments drop and you have some downside protection. And it basically grows and falls with your business. If you do incredibly well, you pay us back a little bit faster, you get access to more capital. And really we're built to fund growth, which when you're a scaling business, it's like a repeatable investment. It's like if I put money into Facebook ads and I know consistently I'm getting, 1.5, 1.7, 1.3 return on ad spend, it's there's no risk really. There's no material risk associated with it, and so there's no reason why you should spend very expensive capital in the form of equity or very time intensive to set up in terms of debt to pay for these things.
Yeah, or
Similar with
just grow
inventory.
organically, right, and just slow up
Yeah,
your growth. And this is precisely why,
exactly.
already, I mentioned this to a few of our clients and very interested because this is kind of like such an important problem that we're facing every day that
Mhm.
this is kind of like a perfect solution for them. And I commend you for coming up with a solution of this kind of like revenue share.
Mhm. Yeah, and I wish we had it back in the Luxbox days. I would have, changed our lives back then.
Yeah.
But yeah, it's just meant to be fast, easy, non-dilutive capital, and take it as you need it. And if you don't need it, we're here. It's almost like just-in-time capital. You can think of it that
Yeah.
way.
And what type of businesses does this apply to? Is it like for smaller businesses or only the ones, like making a few
Mhm.
million a year or, are you working with
Mhm.
like 8 figures plus?
Yeah, so I think that's another differentiator of why we call ourselves the largest ecom investor in the world, because we have the largest portfolio of ecom companies, and the reason why is because our process is so efficient and so lightweight. We fund companies as small as doing $10,000 a month. I think our largest company is doing in the hundreds of millions of dollars a month, or the year. Sorry, $100 million
Yeah.
a year. I wish it was a month. That would be amazing. But maybe by next year they will be. But it spans the gamut, because for us to underwrite and evaluate a company that is very small is no different than a company doing a lot of sales, because we really just care about what is your top line growth, and then how good are you at spending your ad dollars, because that's your main use of funds, and then that's where we are really good at. And from the inventory perspective, I almost like an inventory to ads, in that if you know your return on ad spend, you know what the return is on your inventory. It's just a
Yeah.
mechanism to deliver
Yeah.
what the ad is selling.
Just
And so we
matter of
support both.
time. Yeah.
Exactly.
Yeah. And let's say, how do you work out which businesses to work with and which ones,
Mhm.
it's better to be left over? Are there like any key criteria? You mentioned like data-driven investment, right?
Mhm.
So is there like some sort of maybe you're using some sort of algorithm or
Mhm.
artificial intelligence to judge these things?
Yeah, so it's really any business that has a digital payment processor. So you think of it like Stripe, Shopify, Amazon, BigCommerce.
Yeah.
We're starting to do some stuff with some of the folks like Indiegogo in the early kind of pre-launch phase as well. But
Mhm.
essentially, we need to be able to read a digital stream of what we call immutable data that you can't fake, that you can't falsify. We plug in and have read-only access to that data stream, and that's how we do our underwriting. And there's a whole team of engineers that have built a very sophisticated model that essentially is predicting the growth of this business, and that is what we provide our capital against. But other than that, I guess the only types of businesses we do not invest into today are businesses that have constrained growth. So even if you process
Mhm.
payments on Square, but you are limited like as a gym, and you have fixed number of
Yeah.
spots, or you're a brick and mortar store and you only can service the people in your area, we're not good for that, because we're really trying to spend our capital on things that have no cap to their growth, where you can start an ecom store anywhere in US, Canada, the UK are our three biggest markets, but you can sell around the world. And that's where we really perform well.
Yeah, and my guess is, once people taste it one time, they always come back, right? Because it just fuels their growth so much.
Mm-hmm. Yeah, as you grow more, you get access to more capital, and just becomes this really good booster to your business. With it takes you about if you take all the steps, like you can get an offer within a couple of days and get the capital within under a week. If you pass your diligence process, no one can fundraise that fast. And you never have to leave. You don't have to talk to anyone.
Definitely.
You just
Yeah.
yeah.
I mean, what's the average time, that you give this kind of like a loan or financing to people? Is it like a week or a month, etc.?
Yeah, so we don't go out loans. They're called capital advances.
Mm.
So when you plug in your business to Clearbanc, you can get offers. It typically happens in under a day, normally up to 48 hours, depending on how big your business is and how complicated the business is. And then from that point, within 5 to 7 business days, again, if you're following all the steps, you can
Yeah.
get access to capital. But some people do it, within the same day. Some people take a bit longer. It's incredibly fast if you're motivated.
Cool. And, I know that there are like other options of funding, for example, outside funding and giving out, portion of ownership of company, like losing a little bit of control, etc. But maybe there are like some type of businesses whom you would recommend to taking this option instead of,
Hmm.
let's say, financing through your model.
Hmm. Yeah, so I think equity investment is we've taken on a bunch of venture capital equity dollars as Clearbanc. In my past company, we raised equity dollars. I think where equity is very, very useful are for things that have an order of magnitude impact on the business. Equity is very expensive, right? You're giving up maybe 10% on the very low end to maybe a third or half of your business over subsequent rounds. So if you think about what equity investors are targeting, especially if you go for the very traditional venture, it's like, how do I 3x, 5x, 10x my investment? Which means, let's say if they give you $1 million, they're expecting $10 million back. That's $9 million. That's your cost of capital in the concept of equity. And so there's nothing wrong with that, so long as you can generate a return that's worthwhile paying $9 million for. And to me, those are things like research and development. So are you building a type of business where you can spend money to develop a new product, something that's proprietary, something that's defensible, that will protect you in the long term? Is it hiring? Is it hiring a great executive that you think will be a step change in your business to launch into wholesale or to launch into a new market? Depending on the type of business, if you're more of a software company, is there massive product improvements you can make with a big injection of capital? So it's like, I would think equity dollars are very good for these kind of 0 to 1 outcomes, or like 1 to 10 outcomes, investing dollars that way. And a lot of VCs work with Clearbanc because we, even once they put money into the business, like they also don't want to be diluted either, right? And so if it's simply, I'm going to go raise $1 million, I'm going to put it all into Facebook ads. I'm like, there's cheaper forms of capital out there. Don't use equity dollars for that, because you're going to spend $1 million and then you have to go raise money again, unless you become profitable. Which hopefully you can. So I think that's how I look at equity. It's very good for step change outcomes for the business. And that's that's what your investors want as well. They don't want you to put money into Facebook ads and go, okay, we grew a little bit. They've like, put money into this business and it has a chance to 10x, and your incentives are aligned.
Okay, makes sense now. And I know there are like other ways to do the financing and acquiring the capital, and some of them, as we talked about last time, and we were having a call, for example, like monthly subscriptions that you transform into like annuity, etc. Or, for example, negotiating with suppliers to finance, your stock levels and inventory. Maybe you could talk more about that. Maybe some other tricks.
Yeah, for sure. So I think I'll start to talk about annual subscriptions. And really, there's this concept. If I would encourage everyone to read up on it. It's this concept called the cash conversion cycle. And all that means is like, how fast are you at taking cash, putting into your business and generating more cash? And if you look at and having it's like golf. The lower your number or more negative your number is, the better you're doing. So if you compare, let's say, Amazon to Walmart, everyone kind of objectively says Amazon is much better business than Walmart. But if you look at their cash conversion cycles, that supports it, where Amazon, last time I looked, is in like the negative 20s, whereas Walmart, I think, was close to 0 or might have been positive something. And that might have changed since I last looked at the numbers. But all this to say is what Walmart is what Amazon, what that means is, with a very negative number, is that they collect cash and then they don't have to give the cash to anyone for 30 days from the day they collect it. There's 3 elements to it. Is 1, how early can you get paid? 2, how late can you push off paying your suppliers? And 3, how fast can you turn your inventory? So what you ideally want is like, for the perfect cash conversion cycle, is you collect money today, inventory immediately comes in, goes out, so it doesn't sit for any period of time, and you don't have to pay people for years and years and years. That's like the extreme example of what a good cash conversion cycle would be. And so understanding that framework, that's where subscription businesses and driving annual subscriptions become very useful. So with Luxbox, for example, we didn't raise any external financing; it was all financed internally. But one of the things that really helped us keep the business running was we converted about 52% of our base to pay us annually upfront to subscribe to our service for a year, which meant today I got a year's worth of cash to run the business, and I didn't have to pay my suppliers and all that. for, I didn't have to pay them in that moment. I paid them over 3 periods. Our team, our fixed costs, I'm not paying them all up front. Their salary, I'm paying them over 12 months. And that really helped us run the business and just live off of that cash. And so there's some modern day versions of that. And let's say you can't do that. Let's say you're not a subscription business and it doesn't make sense to do upfront subscriptions. There's a company called Vessi that I saw that did something pretty innovative. It's a waterproof running shoe, or it's run out of here in Canada. And they did something where they launched a new shoe, but you could pay $5 to reserve it because they're known for selling out their product. And so they're pulling $5 up front as this reservation fee that goes against the shoe. And so, it's not a dramatic amount of cash, but you could apply this in so many different ways, especially if you're an early stage business, if you're good at leveraging wait lists and scarcity. There's probably value for people paying to reserve. And so, Tesla does this. Tesla raised millions of dollars to reserve your car. You paid $1,000 a car. So same example. And Tesla has a lot of capital, but they got millions of dollars in cash by doing a pre-sale reservation, right? Another version of it is just doing pre-sales. And so you can do it through on your own site. I think a lot of consumers are more trusting of a platform like Indiegogo, where you can essentially launch a new collection, but have people buy in and fund the production of it before you ever do it. And so I would encourage all the people listening here is how can you just get as much cash up front before you do anything? Because it does two things. One, it obviously gives you cash to fund what you're doing, but two, it's also a data point of let's say you do this Indiegogo campaign and no one buys it. It's your product probably sucks or your marketing sucks. It's don't go drop, tens of thousands or $100,000 in inventory on something no one's going to buy.
Yeah. Early testing, minimal viable products,
exactly.
right?
Exactly. So that's all on how do you bring cash up front? And then on the supplier piece, I really just stole this from one of our venture partners, a friend of mine named Jesse Horowitz. He's one of the founders and co-CEOs of a company called Hubble Contacts, which is they raised over $75 million from Colgate and a number of other investors to build a subscription contact lens business in the US. They're also, I think, in the UK and Canada, a couple other markets. And that's really how he grew Hubble. Was he essentially went to to contact lens manufacturers, and he's repeated this with other businesses to say, hey, you don't have a direct to consumer arm. I can be a direct to consumer arm for you. And, I'll give you a piece of the business. I'll give you a substantial equity stake in the business. And in exchange, give me better terms, make sure extend my payment terms, give me a lower cost of goods. And that then gives him a permanent competitive advantage in the market. And so this is an example of where an equity investment makes a lot of sense because giving them, I don't know what he gave, but let's say a substantial stake could be 10, 15%, who knows, right? That's an expensive chunk of the business, but now you have a permanent competitive advantage where the next person that goes into the market, they may call the supplier, they don't want to do the equity deal, and their cost of goods are 20, 30% higher. So they can't pay the same amount for ads as you can. So you can probably bid them out of the market. By just having a lower margin, you can move faster and you'll just price compete everyone out of the market. And so I think that's why it's such a smart strategy. And it won't apply to every business. Obviously, not every supplier will want to do an equity deal with you. And when I did that talk with Jesse, where he kind of talked through this, he was like, at the end of the day, you're like this little peanut compared to this big behemoth when you're starting. So, check yourself to the door and understand that you don't have incredible leverage. But if you're a good operator, if you've proved yourself, those are things I would consider looking at, of leaning on your suppliers as a source of financing above and beyond seeking equity capital itself.
Yeah. Once again, these things are interesting. And some of them, maybe, I could mention two things that we are using for our own clients to deal with these situations. So one of them is, if you're selling, let's say, consumable product, etc., what you can do is just do quantity upsells. It means selling not one product, but person would be using for a month or two, but selling 3 or 4 or 5 items stacked for a discount. This way, kind of leaning back to a similar idea what you had, subscriptions and paying here up front, right? This is kind of different, not subscription, but I think this will be more applicable to majority of businesses and people listening to this podcast. Another thing would be just deferring payments. Honestly, if you have a track record of your current supplier, call them up and say, hey, I will pay you a bit more, right? If you can allow me to pay 90 days later. First, send me the stock, right? And I will pay you later. This is how you basically build up, the capital, and suddenly, you have like additional 50, 100K in the bank. And for a smaller business, it could be a huge difference. And if you're a bigger one, you could get, like completely exclusive terms. It depends, how well you deal with these things. Once again, strategy is important.
100%. 100%.
Cool. So, okay, let's talk about a bit different topic. You get the injection of cash, right? What is next for a business? What do you see, the smartest players in the market doing with the cash that you're receiving?
Yeah, so I think it really just becomes like a math equation of where you're going to get the best return on your investment. So I'll put aside any kind of like fixed costs. So, if you make sure you have the right team, make sure you have all the infrastructure to do all the things you need to do to scale. Like I'm a big believer of, you don't want to dump a bunch of growth into a business that can't support it, because then you're just going to make everyone disappointed. So that means you want to make sure you're not going to stock out. You make sure you want to handle customer service, whatever could break when you scale the business, like be mindful to have money set aside to fix those things or invest in those things, or else you're going to just bleed a lot of customers and ultimately not come out the other side too well. So putting that aside, which will be unique for every business, I think when you start looking tactically at your different marketing channels, you should really look at like how well can each scale and what's the upper limit of that. So the reason why Facebook and Google just dominate the market is they have almost like an unlimited amount of inventory for marketers to buy, whereas things like programmatic display, or you're very old school, like doing deals with publishers and things like that, the audiences are very small. Even podcasts, like I've heard very mixed reviews from marketers, where some are very, they find it, very good economics. But at some point, once you've bought the top 5, 10 podcasts, your growth as a business is limited by the growth of that podcast. And so it's like thinking about, in terms of the best marketers I talked to in the exact days, was they were very mindful of not only what's the return on investment, but how much can this scale? And if they really can't scale that much, then it's not even worth testing, because if it's like crushing it, I won't dramatically grow my business if I can't double, triple down and get good economics. And really what they're saying there is that the marginal cost of acquiring customers in smaller channels goes up and up and up. Meaning, let's say you, did a deal with the Joe Rogan podcast, right? He's huge podcast, whatever, and you dump $100,000 and you get, a $10 cost of customer acquisition. You're like, oh, amazing. That's so cheap. It's like 5 times cheaper than what I'm getting on Facebook. He's okay. I'm going to do double the number of Joe Rogan episodes for $200,000. But all of a sudden you're not acquiring any new customers, and your marginal cost of the next customer is like $100, because all the people who love you that listen to Joe Rogan already bought it. And so even if you're blended, be like, oh, okay, I'm acquiring people now for like $20 a customer. It's still cheaper. If that next tranche costs you on a per head basis, 50, 100, whatever it is, was actually probably not the greatest investment. So you want to think about like pressure testing, not what just your average customer cost of acquisition is, but how does that scale as you add more dollars? It's probably going to look like some curve of like, you're going to get really, really good economics as you get more efficient and figure it out. And then it's going to plateau, and then it's going to start skyrocketing because you've kind of tapped this well of customers, whether it's a particular keyword or a particular audience group on Facebook or a particular type of creative or whatever it is. And you also want to tie that to understanding your lifetime value of that customer, because even if you may pay double to acquire a customer, if that source is like 4 times as valuable, it's probably worth it. So you want to look at your return on ad spend, not on that first purchase, but you want to look at it over the long period of time. And I think the best marketers that I've seen are also very, very frugal and very kind of ruthless at like, if they're not a true subscription business, if you can't really guarantee that like, oh, I'm selling a consumable that you're going to buy and buy again, or I'm like a subscription box where I know you're going to sign up.
Yeah.
If you're not 100% sure, there's not a reason for someone to come back. They really try to aim, how can I be first purchase profitable? Because there's no guarantee they're going to come back. And if you get into this, and to all the stuff that you talk about on AdKings and your other content of, can you use bundles? Can you kind of increase that AOV of your first purchase? You really want to figure out, how do I make sure I'm not just losing money on this first sale and just banking that they come back? Because maybe they will for now, maybe they won't. That's like an unknown. And those are the people that run the kind of most efficient businesses. But the last point I'll make too is, if you look at some of the biggest wins in D2C, is they run very lean operations overall. So a great example of this is Native. Native sold their business to Procter & Gamble for $100 million cash upfront. He raised, I think, just $1 million, and not even, or $500,000. Otherwise, all bootstrapped. I think when he sold to P&G, he had 8 employees, maybe 15 at the most. Like he was still the one. His name was Moise. Moise was still like running the Facebook ads and Pinterest ads himself. Like he had an agency helping him, whatever, but like he was the one running that show.
Yeah.
And he sold a business for $100 million with like whatever, 10 people, let's call it.
And this is the beauty of e-commerce these days, right? You do not need a huge team, right? You do not need like 200, 300 people. Of course, you can go that route, right? But you can also stay lean and be kind of like, like use all these fixed costs that the big giants are burning money through to finance your growth.
Yeah.
And just basically buy more ads.
Yeah, that's it. Really invest in, and just be careful where I think to the point of, I'm kind of going on a tangent, but to the goal point of like testing new channels and things like that, often that's tied to like hiring a person to go do that. And that's where agencies or third parties are very, very helpful of like, find an agent. Like if you're just starting out, find someone that you can trust to run your digital. But if you're going to go expand into, direct mail or podcast, find an agency to do that for you first. Because if it doesn't work out, you and agency can part ways. You don't have to fire someone. You're not going to, go through that emotional strain of like hiring someone and letting them go because you picked the wrong channel, not because they're like a bad operator, right? So that's my long answer to your question.
I mean, longer answer is better. We are all sharing value here. And maybe there are like any other often overlooked areas, that people should be investing to, because we talked about ads, etc. But you get the cash right. Maybe there are like some areas that a lot of people kind of like miss on.
Mm-hmm. I know at the larger end, I'm seeing more people go into nonlinear TV. So these are companies that are doing the hundreds of millions of dollars. Mostly even if you're not venture backed, it's people at the venture backed scale. So NBC Universal has built a team they call Direct to Scale that's meant to just focus on supporting these types of high growth direct to consumer businesses. The cost of testing TV is not as expensive as most think. Like you can do it for like 100,000, under 100,000 and dabble in it. So that's like a new area that, probably is not a fit for like the person just starting out. But if you are seeing good economics and you have extra cash and you're really trying to grow, TV still works as long as you can find the good economics behind it. Really outside of that, my personal background expertise has always been in partnerships and business development. I mean, that's how Exact started. That's how we did a lot of our deals back at Luxbox was we didn't do paid ads. We just, partnered with influencers, partnered with publishers. So it's, I couldn't say this is a repeatable thing for everyone because you have to have the skill set and your product has to be able to fit with others. But can you think about other founders and other businesses where you can partner or bundle? It's no different than thinking about it as going into retail and wholesale. So the broader answer is another thing I'm seeing a lot of people doing is not ignoring brick and mortar and just getting a wholesale director and going after your Targets, your Walmarts, your Amazon. You can do FBA. Depending on what country you're in, there's different retailers that I would look at and sell into. And that is like, if you look at Harry's as a great example, Harry's, I think when I last saw them do a presentation, like more than half their sales came from Walmart. Even though they're this great direct-to-consumer brand, it's really a Walmart brand. And so the partnership with Walmart, it's really just a B2B sales process. But on a smaller angle, there are great sites like Faire.com, for example, where you can have your product bought by kind of small independent boutique retailers. So little gift shops around the US and Canada, as an example. And so I wouldn't ignore wholesale or, non-direct to consumer retail. It could mean doing a partnership. Let's say if you're a shoe brand, it's partnering with an apparel brand and, cross-selling your shoes on their site and their apparel on your site. And how do you just get this free distribution by trading your audiences and things like that? Those are, I think, underrated, underlooked things if you can find the right partnerships. But that's, I would say hard to say, here's a scalable thing that works for everyone because there's so many factors that'll determine if that's possible or not.
Awesome. So, Luke, I think we kind of covered pretty much all the questions here. So, really appreciative of your time. And maybe you could introduce yourself a bit more. Well, not introduce yourself, but basically direct people where they could learn more about you and Clearbanc. And maybe, figure out if your solution is what we need.
Yeah. Yeah, so you can go to clearbanc.com, and we have a few different tools to help out e-commerce founders. It all starts with getting a free valuation of your company. So within 24 hours, you can get a sense of how much is your business worth and use that. A lot of our founders are using that as a way to stay accountable, to say, how am I growing my valuation week over week? The number always continues to update. And then from there, that helps you get access to some of our other tools. We have insights and benchmarking that'll help you understand how you're performing relative to your peers on things like return on ad spend, customer acquisition costs, and so on. And then from a capital perspective, as we talked a little bit about, we can fund companies up to $10 million by simply connecting your accounts and engaging with our team. It takes no more than 48 hours to get an offer. You can do it completely self-serve or talk to someone on our team to do that. And we're really here to fund your repeatable growth. So if you're looking to gear up for Black Friday, Cyber Monday with ad spend, or you're making inventory buy for 2021, if you're about to sell out of your inventory for this year, we have our marketing product for ads, and then our inventory product. Essentially, we will buy your inventory, and you won't have to pay us until you sell it. And so it's a pretty attractive value prop if that's something you need.
Awesome. So what, Daniel, thank you for coming here today.
Appreciate it. Thanks so much for having me on the show, and I look forward to chatting again with you soon.